nani alireplace ile na ile bado tutaka nini ile bado tunataka mwisho na nacho sasa ile naitoanga hata ikichomeka replace ile.
Okay, good afternoon. Welcome back to our live photo podcast. Live stream video. Again, I want us to do, as I said, we are going to do. One is today is piecemeal acquisition. Piecemeal acquisition of subsidiary. For just acquisition of subsidiary. So the first segment we saw how to change the subsidiary of a company from associate to what it controls. Now we want to look at a situation where already the control has been achieved. You're just adding more shares of the company. This again in advanced financial reporting and analysis in the advanced level of CPA. So acquisition of a subsidiary when already control has been achieved is slightly different from when you come from. Here they say, I had my short notes here, and piecemeal acquisition already control increased, where control increased. Control is increased. So maybe a company was controlling 60% of B, and then it added more shares, more maybe 20%. So it's now controlling 80%. What happened in that situation when you find there's a change in the percentage control? So you know that in any case, control is increased. There is no acquisition because already acquisition had taken place. The control had taken place. The only thing that will change, you'll find that there will be increase in cost of in the percentage control, and there will be reduction in NCI and then non-controlling interest. For instance, if NCI, if you are controlling 60, the non-controlling interest will be 40%. But if you come to 80, NCI now becomes 20. So what goodwill, but goodwill, you compute goodwill as at the original cost of control, that is at 60%. If you use in this case, don't say like now because come to 80, now you deal with 80%. So you just get the goodwill as per the original or the time that acquisition was realized first. Some few things might change for NCI. NCI is interesting here. NCI format, whenever the NCI format, what will change in the non-controlling interest is that you will have got value at point of control, and then you also get NCI share. Let's say share of post-acquisition retained earnings. Share of post-acquisition retained earnings. Then of course you get also NCI portion of parent. Portion of parent, maybe at additional shares. So when that share is added, you also now deduct it at the journal entry. And then you also add NCI share at closing or at reporting date. NCI share of profit. NCI share of profit. At closing date or at reporting date. Just add it. Then the answer you get will be NCI. So the fair value, you can use the net asset value, or they ask you to use the fair value. Then you net assets value the ordinary shares, premium, those equity items. But if they tell you like NCI was measured at fair value, you have to restate it at fair value. So it's slightly, the only difference with the one we did earlier is that here the NCI, at that point NCI was changing with the change in control, but here already control has been achieved. So there will be a reduction in NCI, and that's how you account for reduction in NCI. So NCI at fair value at the point of control, you see it there. This one is always given the equation. If they don't give you, then use the net assets at the time the control was achieved first. If in this case, hypothetically, at 60%. So get the NCI control at 40%. Then you also get the NCI post-acquisition retained earnings. That is from the point control was realized up to the time now you are adding more of those shares. And then you look at now the NCI portion under the journal entry that we're going to find. So journal entry, there's always a journal entry that is done, because sometimes in the draft statement of financial position, you always find that they'll give you the cost of investment or the cost of this ordinary of subsidiary, including the additional shares, that the additional investment. So you have to change that one so that it fits. You have to change that one so that you only concentrate on the NCI or the control at the original point of acquisition at 60%, if in this case. So journal entry, so this is what you do in case you have journal entry, then you say NCI at point of acquisition, the point you acquire the control. At point you acquire the control, then you get, I'm repeating here, you get UDR, you debit NCI decrease with the decrease in NCI. So you see the NCI will decrease. If it was 40, and now maybe it turns to 20. So you have to get that decrease. And you can also debit again retained earnings. Retained earnings directly in equity. Directly in equity. Credit the cost of control. Cost of control. So you credit. So the cost of control is the cost at which you added the additional shares. So you credit it. By crediting it, this one, even when you are getting cost of control in competing goodwill, you also ensure that you credit it at that point. Good. So now, much has been introduced. So be very careful when you're competing goodwill, and be very careful with your retained earnings, and also the non-controlling interest. So I want us again to solve another question here briefly, as we navigate through this problem. So this was again set in August 2022. So let me run here. This is August 2022. Question 1 again. August 2022, question 1. Advanced financial reporting. Question 1. So here it goes. Public has held a controlling interest in S Limited, another public limited company, for 1 decade. Also, influence over A Limited, a public limited company, and a public limited company. All the companies operate in the manufacturing sector. The draft statement of financial position of P Limited and S Limited as of 30 June 2022 was shown below. So if you are having that question, there is a draft financial statement for P and S Limited. Assets, non-current assets. We have got property, plant, and equipment for both the companies. If you'll access this question as you will be revising, or if you have it, you'll be seeing those figures. It is CPA, Advanced Financial Reporting and Analysis, question 1. So you'll see those figures. Property, plant, equipment for P Limited is 16. Okay, the numbers are in millions, so I'll just read them as if they're truncated. So property, plant, and equipment for P Limited is 16,875 million. For S Limited is 10,230 million. Investments, S Limited, so P Limited for 13 million was invested. P Limited also invested in A Limited for 3,650. Okay, 3,650 million. Then financial assets at fair value. Current assets, inventory, trade receivables, cash and cash equivalent for both the companies. So inventory for P is 9,980. Receivables for P Limited 9,480, for S Limited 6,580. Cash and cash equivalent for P Limited is 5,490, for S Limited is 3,815. Then there's total assets. Equity and liabilities, equity, ordinary share capital 10 shillings each. For P Limited is 20,000, for S Limited is 10,000. Share premium 4,000 for P Limited, 2,400 for S Limited. Retained earnings for P Limited is 16,670, for S Limited is 5,950. Total equity. Non-current liabilities, there's 10% loan notes, there's deferred tax. Current liabilities, there's trade payables and current tax. Additional information, they say that on 1st July 2012, P Limited acquired 60% of the ordinary shares in S Limited for a cash consideration of 10,000 million shillings. At acquisition, the fair value of non-controlling interest in S Limited was 6.5 billion shillings. P Limited wishes to use the fair value method of accounting for goodwill. On 1st July 2012, the fair value of identifiable net assets in S Limited was shillings 14 billion, and the retained earnings of S Limited were 1.2 billion. The excess in fair value was due to non-depreciation land. Limited acquired a further 20% interest in S Limited for a cash consideration of 3 billion. S Limited net profit for the year ended 30 June 2022 of 500 million shillings, which accrued evenly throughout the year. During the year, it's worth 2 billion shillings to S Limited. P Limited reports a gross margin of 25% on all its sales. Half of these goods were stayed in the inventory of S Limited as at 30th June 2022. For goodwill was tested for impairment immediately after the additional acquisition of interest in S Limited and was considered impaired by 10%. No impairment had been reported in the previous years. 5. On 1st July 2015, P Limited acquired 30% of 1 million ordinary shares of shillings 10 each in A Limited when retained earnings of A Limited stood at 1 million shillings. A Limited had no other reserves as at 1st July 2015. As at 30 June 2022, the retained earnings of A Limited were 3.5 billion shillings. No impairment was deemed necessary in respect of the investment in A Limited. Number 6, they said none of the group companies declared or paid dividend during the year. 7, none of the group companies issued additional shares. Required, determine the non-controlling interest in S Limited as of 30 June 2022. Included a statement of financial position as at 30th June 2022. Good. So this is a very interesting question. You've realized that already this company had acquired in 2012, and then coming again in 2020. He added more shares in 2022. I think 10 years later, almost more than 10 years later, he acquired another further 20%. So as I told you, like goodwill, you are going to compute goodwill based on 60% when acquired, not when they added. But now you know here that initially up to 2022 January, timing of acquisition. So timing is very important. Timing, we have what 2012, they acquired 60%. Now, February 2022, they acquired another 20%. So we are having 80% here. But this people are recording their financial statement on 30 June every year. So 30 June 2022. 30 June 2022, there's additional, now it's controlling 80. So you must ensure that the profit you are giving must reflect the timing from what time to what time. Maybe like now from here, this thing was acquired only, 80% was acquired only, or maybe the additional 20% were acquired only 6 months to the end of the financial year. So ensure that the retained earnings for that year, you must apportion it for 6 months. So that is the first thing we do. So let's compute goodwill. As we do goodwill, we are also going to find ourselves computing also the NCI. So goodwill computation. Goodwill computation. So I told you, use the cost of 60%. So consideration, cost, they told us here to be 10,000. They said here the consideration cost was 10,000. And they're telling us here that the NCI, because they told us that the NCI was 6,500. That told us in the question, it was 6,500. So we are using full goodwill method. And then net assets, they told us net assets were measured at fair value at the time 60% was acquired. And net assets, they told us to be 14 billion. So these are in billions. These are in millions. So 14 billion. So goodwill is 20.5 billion. That's goodwill. And then they're telling us that the goodwill was impaired by 10%. So they say that there's an impairment loss of goodwill by 10%. So you can get impairment loss. Is 10%. Then net goodwill now will be goodwill less impairment loss. So 500 minus 250, which is coming here to be, if I use my calculator here, 500 minus 250, you get 2250. So that's the net goodwill. that you're going to disclose in the statement of financial position. So remember, goodwill you compute at the time control was acquired, not at the time additional shares were acquired. Now, there's something that told us again here in the question that there's the fair value difference, because they told us the fair value by 2012 was 14 billion. And then there's, because you guys know what fair value means. That is IFRS 13. I don't need to teach you guys those things. So let's look at the book values. That the difference between the fair value and also the book value, that difference relates to depreciable land, non-depreciable land. So let's look at the fair value of the book value. Book value of net assets. Net assets of book values of S Limited. And then you can go to compare it with the fair value, which was 14,000. So ordinary share capital. Ordinary share capital of S, because they did not issue any equity shares since that time. Since 2012 was 10,000. And then we had got share premium. Share premium was 2,400 for S Limited. And then retained earnings at the time of acquisition. Pre-acquired retained earnings. Pre-acquisition retained earnings was, they told us there was 1,200. It was 1.2 billion. 1.2 billion. So those were the net assets by the time they were acquiring this company. So let's find that total. So 10,000 plus 400 plus 1,200. You get 13,600. 13,600. And fair value of S Limited, they told us there was 14 billion. So the difference means land, which was 400 million. That's how we find the value of land. 400 million, that's the value of land. And as you know, value of land does not depreciate. So we're going to include it when you are consolidating our group property, plant and equipment, or group PPE. Good. So after doing that, after finding the value of land, which we are going to consolidate, we are going to also find out now we can find the total net assets. The total net assets before 80%. This is the net assets by the time. This is the net assets by the time they acquired 60%. This is the net assets by the time 60% control was acquired. Of course, they also use fair value. All these things were by the time 60% was acquired. So can you get the net assets by the time now additional 20% shares were acquired? So you can get net assets at 80% control. Net assets at 80% control. So again, we know that the ordinary share capital was 10,000. This one's no change. Actually, up to 60%, as at 60%, net assets were 13,600. And that's at 60%. So what changed there was retained earnings, because for almost those 10 years, the company realized some retained earnings. So retained earnings now changed in that we have 1,200. We have 1,200 here already. So between 2012 up to 2022, we need to get the retained earnings between 2012 when they acquired 60%. And 2022 when they are acquiring additional 20%. So here, we know that the retained earnings as at 30th June 2022, when they're reporting this financial statement. In the question, the retained earnings are giving us to be 59.50. You see, that includes even the pre-acquired retained earnings here. So because I've accounted for 1200 as the pre-acquired retained earnings, I can now remove it here. I can remove it so that I only indicate, because this 13,000 already includes the retained earnings of 1200. So I know that the difference, the difference here includes or denotes the retained earnings from 1st July, it's 1st July 2012. Yeah, from 1st July 2012 up to the date they're reporting the financial statement. Up to the date they're reporting the financial statement. But even in that date, there was also additional in the year 2022, the whole of year that is ending 30 June 2022, S Limited made a profit of 500 million. But you see now, the 20% was acquired. The 20% was acquired half year. It was on 1st January 2022, just 6 months to the reporting date. So you have to deduct also, because that part of that half is also pre-acquired. Half is pre-acquired. That means it's pre the additional 20%. Pre the additional 20%. So you deduct that one. So 500 times 6 over 12. So that is the extra retained earnings, which was pre-acquired. So you had it there to be, if you get that additional, so let's compute it. So 5950 minus 1200 minus 250, because half of this is 250. You get 4500. You get 4500. But now, now if you add it, you get 4500. And so it was 10,000 plus 2,400. Then there's also land. I'm forgetting land. There was also land here. The land that we got the value to be 400 is also part of information here. So if I add it, 13,600 plus 4,500 plus 400, I'm getting 18,500. So this is the total net assets when additional 20% was acquired. So when they are controlling 80%, you find that the shares were the net assets. So total net assets as at, this was by the time they acquired it, was 1st January 2022. The net assets were 18,500. So what was NCI at that point? NCI was now, NCI is 20% of 18,500. 20% of 18,500. So that is a reduction in NCI. So you get that 700. That's a reduction in NCI, because it's now from 40. If at all you were to get for 40, if it was at 40% NCI, you'll get 7,400. So there's a reduction in NCI. And that reduction in NCI, remember I told you to run a journal entry. So there's a journal entry that we have to run to indicate how that thing changed. And in case there's a reduction, you compare the additional cost. Because they told us that the new shares, the new 20% shares cost these people 300,000, 3 billion or 3,000 million, 3 billion. So you're going to compare it with the change in the NCI at 20%. So if at all the NCI at 20% exceeds the cost, then that will be like a gain in the NC, in the group retained earnings. If the NCI exceeds the cost, in other words, the value that they increased exceeds the cost that they bought it, then that will be a gain that you are going to report in the consolidated retained earnings. But in case if the cost exceeds the fair value of NCI or the value of NCI at the additional the additional 20%, then that will be a loss. So let's run the journal entry. Let's run the journal entry here. So journal entry. So I told you always will be debit the reduction in NCI. So here NCI decrease will decrease. A decrease here was 3,700. So here 3,700. And then CR the cost of control or the consideration. So CR cost of additional shares. Additional shares, which in this case was 3,000. The additional shares 1,000. So you can see that this journal entry is not balanced. So again, you credit here. There's a difference for it. For this journal entry balance, there's a difference of 700 that you'll have to credit. So that's 700. You debit what you credit what you call group retained earnings. Group retained earnings. Group retained earnings. So when you're going to group retained earnings, you're going to add the fair value, the change, of the increase, of the gain in the NCI. So having done that, now it's possible for us now to compute the NCI, because it's a required, that we are asked to do is to compute the NCI. So NCI up to the point of post-acquisition, just before acquisition, so let's get NCI share. NCI share post-acquisition. Maybe at that 40%, that is at 40%. So we know that the post-acquisition retained earnings, in this case was, so the retained earnings here was 59.50 here. So 59.50 minus the pre-acquired retained earnings, which was 1,200. Again, minus half of the control. They say that we agree that if they made a profit of 500, and then the cost control at the time of 40%, the pre-acquired was, before they added more, have been the post-acquisition retained earnings 40%, or when they were controlling 60%, was 250. Or for that was after they added the 20%. So times 40% that they previously held. So that is coming 59.50 minus 1,200 minus 250 times 0.4 times 40%. You get 1,800. So that's also going to add to the NCI up to the time before they just added the extra 20%. So we have all the information now to compute NCI. So let's get NCI as at 30th June 2022. So here we have got NCI fair value. NCI fair value at 2012. At 2012, we were told it was 6,500. So it was 6,500. And then we also now add this NCI up to the time 40%. So NCI profit, share of profit at 1st January 2022, or at the time before they just added the 20% extra was 1800. That is a share of profit. And then now you left this decrease in NCI because I've said you debit NCI. No, NCI is an equity. Anytime you are debiting NCI, it means you are deducting it. So we write here NCI decrease. NCI decrease. We found this to be 3700. So you remove it. And then we finalize with the NCI after they added now the extra NCI share of profit, after they added now the extra 20% control. So NCI at NCI share of profit at 20% additional control. So we know that it was half year because they acquired the additional 20% 1st January and they're reporting 30th June. So 1st January to 30th June is 6 months. And they made that year they made a profit of 500. 500 times 6 over 12 times 20% that they were controlling. So that one you get 500 times 6 over 12 times 0.2 or times 10%. You get there to be 50. Get that to be 50. And that's what you add to get now the NCI. So the solution here will give us the NCI. So that 50 plus 6500 minus 7700 plus 1800. You get NCI to be 4650. 4650. That's the NCI as of that date. Now, what the working that is remaining for us is we need to look at the unrealized profit because there was some intercompany sales. So let's run this unrealized profit, and then we do the consolidated group retained earnings, and then we also look at the investment in associates. So let's look at the unrealized profit. These things now, you guys are familiar with them. I don't need to teach them. They say that during the year ended 30 June 2022, P Limited sold goods worth 2 million US Limited and report a gross profit margin of 35% on all its sales. Half of these goods remain in stock. So that's unrealized profit. I always call it URP. Unrealized profit. The value of the goods that were sold were 2 million. Yes, 25. The margin is 25%. So we're going to use margin. So 2,000 times 0.5 times 0.25. So you get 250. So 250. So eliminate it. The group retained earnings. The group limited because they in 2015. They say that on 1st July 2015, P Limited acquired 30% of 100 million shares of shillings 10 each in A Limited. The retained earnings of A Limited had no other reserves at July 2015. As at 30 June 2022, the retained earnings of A Limited were 3 investment limited. So let's look at A Limited. $1 million. No, it was okay. See, the statement was 3,650 million. So that's 650. Post acquisition profit. Post acquisition. As at this year, that is 30 June 2022, the cost was, the retained earnings was 500, but when they are acquiring the retained earnings times 25 times 30%, because they were controlling it at 30%. 30%. So the difference 30%, you get 750. That said, the fund. So H in the group retained earnings, the total retained earnings was 70. And then S Limited, which was a subsidiary. Share of S Limited retained earnings. Now we are going to find the retained earnings when it was controlling 60% and also when it's controlling 80%. So S Limited 60%. At 60%, you know that the 5950, that was the retained earning as at this date, the reporting date, minus pre-acquired, which was the retained earnings in 2012, it was 1200, minus the half of the year that they added. So we have it there. Let's see. 950 minus 1200 minus 250 times 0.6. You get 2700. And then we have got share of S Limited at 80%. At 80%, it was simple. We had even done it here. It's just half of the 500. It was 500 which they made in that year, but it was halfway. So 6/12 times 80%. So that is 500 times 6 divided by 12 times 80%. You get 200. So those are the incomes. Then you can get also share of A Limited. A Limited, which is an associate. Post acquisition, we have done it here. You don't need to repeat it. It's 750. The way we did it in the cost of the investment in A Limited, which was 750. And then we get, there was impairment loss of goodwill. Impairment loss of goodwill. That was our first working. It is here. Goodwill impairment loss was 250. So we deduct it. And then there is also URP. You eliminate that unrealized profit. So unrealized profit from that intercompany trade. Realized profit we've also found here to be 250. We also deduct it. And I think from there, you are done. You just now need to get the group retained earnings at that point. So let's complete. Plus 700 plus 750 minus 250 minus 250. which was come to find out I got something in case I forgot. So it's coming to be 1898. There's this introduction which was in NCI, or just gain in additional acquisition of additional 20%. Control. So 700. So if I add that, it generates. Working. Six. This is working 7. Then it's a shift. Then this is working. I'm going to wrap them so that I now do the consolidated statement of financial position. So NCA, they asked us to get NCA, so NCA we did it in working 6. And now we can now get to so so they were calling themselves, it was P Limited. P Limited consolidated statement financial position. So we're going to have here P Limited. I need to write from up because this thing sometimes is long. So P Limited. Consolidated statement of financial position. As that is June 2022. So we have what assets, shillings in million, so we can start with our PP, the property, plant and equipment. PP we are going to check for the adding, we are adding for P and also for S. 16,875 plus 10 to 30, which was for S, plus 400, which was the undepreciable land. So if I do that, 16,875 16,875 plus 10 to 30 plus land, which was 400. Getting here 27,505. And then I can get to investment in A Limited, the associate company. Investment in A Limited. A Limited, we did it now working. It was 4,400. 4,400. And then we also got goodwill because it had impaired. It was working one, which was 22.50. And then there was financial assets at fair value. Financial asset at fair value. That one was only P that had it, so we just put for P. It was coming to be 6190. The equation is given by 6190. And then you can get total non-current assets. Total non-current assets. Plus 2250 plus 6190. We get 40,345. And then we can now get current assets. Current assets, we have inventory. Inventory in this case was 9980 plus 6930 minus the URP, which was 250, and realized profit, which was 250. So 9980 plus 6930 minus 250, 16,660. 16,660. Then we have trade receivables. Which was 9480 plus 6580. So there was no intercompany indebtedness. So if you add those two, 480 plus 6580, 16,060. Which was 5940, 5490, sorry. 490 plus 3815. So 6940, 5490, sorry. Plus 3815. Get there 9305. So that's 9305 plus 16060 plus 16060. Get that to be 42. Then you get total assets. So plus 40,345. Get 82,370. 82,370. That is our total assets. Now we go to equity and liabilities. Equity and liabilities, we have got under equity, ordinary share capital. Ordinary share capital, again, we only use the one for the parent company. For P Limited, it was 20,000. This other one have been absorbed in goodwill. Then share premium, Share premium was 4,000. Then retained earnings. Retained earnings, we did it in the other segment, in the workings. I noted it somewhere here. Retained earnings was 2520. 2520. Then you can get owner's equity or parent's equity. Owners or parent's equity. So if you add those three, that's 24,000 plus 2520. You get 44,520. 44,520. Then you get the MCI. The non-controlling interest, we did it. It was part of our working. It was 4650. 4650. Then from there you can get total equity. So 520 plus 4650. You get 49,170. 49,170. You have apparent liabilities. We have 10% loan notes. 10% loan notes. So fee was limited was 10,500 plus 3,100 plus 3,500 for S. So 10,500 plus 3,500. And then you get deferred tax. There was deferred tax. Deferred tax for P was plus 1870 for S limited. 5150. You get 8020. So the total non-current liabilities 22,020. Then you go to current liabilities. We have trade payables, or account payables. It was 700 for P limited and 3,100 for S limited. So if you add those two, 700 plus 3,100, you get 8,800. Tax. Current tax for P limited was 1645. S limited was 735. So let's have them. 1645 plus 735. Get 2380. So total of current liabilities, get 11,180. Then now you can get total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So let's add them. So 11,180 plus 22,020 plus 49,170. Get 82,370. 82,370. So That's how you to do it. You ensure that it balances with total assets. Ensure that it balances with total assets. So that's how you are to complete it, and you need to save time, because the exam that should take you 30 minutes to do. So that's how you to do it. On how to change acquisition. I mean, in case there is a change in shareholding. So we have solved it. So until we see each other. In case there's a question, just drop it on your comment section. That's it. So for now, goodbye until next time. Next time I'll do a question analysis for intermediate students. So until next time, you get bye for now.